Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Now I'm continuing the problems on CVP analysis. Last video, 4 problems I have completed on CVP analysis. In this video, 5, 6, 7, 8, 4 more problems I'm going to explain. So before starting the problems, I expect my viewers to have a printout of the problems which I have given in the link under my description. Without problems you cannot understand. So take the screenshot of the problems which I have written on the board, then I'll explain all the points in detail. Now see the fifth problem, problem number 5. Direct material per unit 180 rupees, direct labor per unit 100 rupees, variable factory overhead per unit 20 rupees, total fixed factory overhead 15,000, selling price per unit 500, variable selling expenses per unit 20, fixed selling and administrative expenses 30,000 required. Calculate the total variable cost per unit. Second, calculate the total fixed expenses for the year. And third, calculate the margin of safety. So 3 questions are asked. One line is missing. There is a misprint there. You write down number of units sold is equal to 400. Above direct material per unit 180 rupees is given now. Above that you write down number of units sold is equal to 400. That line was missing in this paper. So this is the data given. So one by one we will attempt. The first question, calculate the total variable cost per unit. Here variable costs are given: direct material, direct labor and variable factory overhead and variable selling and administrative expenses. So here first, variable cost per unit. So direct material per unit 180 rupees, direct labor per unit 100 rupees, variable factory overhead per unit 20 rupees. And variable selling expenses per unit is 20 rupees. So total variable cost per unit 320 rupees. So remember, variable cost consists of direct material, direct labor, variable factory overhead and variable selling and administrative overhead. That's it. So first question completed. Second question, calculate the total fixed expenses. So in our problem, the fixed expenses are given: total fixed factory overhead and total fixed selling and administrative expenses. Only 2 items are given which are fixed. Fixed factory overhead 15,000, fixed selling and administrative expense 30,000. Total is 45,000. That's it. So 2 questions we have completed. The last, calculate the margin of safety, MOS. So the formula for MOS is actual sales minus break-even sales. So here, margin of safety, number of units sold 400. And selling price per unit is given in the problem 500. So if you multiply 400 units into 500 rupees, we will get the actual sales. So here actual sales are 2 lakh. Now break even point, BEP. The formula for BEP is fixed cost divided by PV ratio, profit volume ratio. The fixed cost is already given in the problem here, 45,000. But PV ratio we don't have. So first we calculate PV ratio, C by S. C by S, contribution by sales. So in place of contribution I am taking S minus V. S minus V by S. So S stands for selling price and V stands for variable cost. The selling price is 500 and the variable cost is 320. So 500 minus 320 divided by 500 into 100, 36%. This is the PV ratio. Now easily we can calculate the break-even point fixed cost by PV ratio. The fixed cost is 45,000, PV ratio is 36%. So 45,000 divided by 0.36. Remember, you can take in percentage or you can take in fraction. So denominator you can write 36% or you can write 0.36. You will get the same answer. So 1,25,000 is the break-even sales. Now easily we can calculate margin of safety. MOS is equal to actual sales minus break-even sales. The actual sales are 2 lakh and the break-even sales are 1,25,000. So 2 lakh minus 1,25,000, 75,000 is the margin of safety. That's it. This is the end of problem number 5. Now, problem number 6. An analysis of cost sheet is as follows. The two columns are given: variable cost, percentage of sales, and fixed cost. Direct material, we don't have fixed cost, and variable cost is 32%, 32.8% of sales. That means simply material is 32.8% of sales value. What is the sales value? We'll see. Then labor, 28.4% of sales and no fixed. Factory overhead, 12.6% of sales and 1,89,900 fixed. That means factory overhead we are having variable as well as fixed. Similarly, distribution overhead, 4.1% of sales, that is variable, and 58,400 fixed. Lastly, general overheads are 1.1% of sales, that is variable, and fixed 66,700. There is a printing mistake there. 66,780 is given there. That is a mistake. So make it 700. 66,700. This is the correct amount, fixed cost. Then budgeted sales are 18,50,000. So total sales are 18,50,000. Now you are required to determine break-even sales value. Means BP we have to calculate. Profit at budgeted sales. How much are the profit at this budgeted sales of 18,50,000? Then profit if actual sales are dropped by 10% and increased by 5% from the budgeted sales. So 3 different questions are asked. One by one we will attempt. First of all, total fixed cost. Here the fixed cost is given separately for factory overhead, distribution overhead and general overhead. Separately given. We combine it all. We want the total fixed cost. So simply we add up 1,89,900 plus 58,400 plus 66,700. The total fixed cost comes to 3,15,000. Now variable cost. Variable cost as a percentage of sales. So we will add up all the percentages. 32.8%, 28.4%, 12.6%, 4.1%, 1.1%. If we add up all, you will get 79%. That means the variable cost is 79% of sales. The variable cost is equal to 79% of sales. Sales are given 18,50,000. So 79% of 18,50,000, 14,61,500. This is the total variable cost. Now, one by one attempt. We'll attempt one by one. First one, break-even sales value. That means break-even point. The formula for break-even point, fixed cost divided by PV ratio. This first formula. Another formula is there, F into S divided by S minus V. Any formula we apply, we'll get the same answer. If we apply fixed cost by PV ratio, so first we need PV ratio. Then only we can apply that formula. Without the PV ratio, we can apply F into S divided by S minus V. So here I am applying BP in rupees is equal to F into S divided by S minus V. F stands for fixed cost. Already fixed cost we have calculated 3,15,000. S, sales are given in the problem 18,50,000. Sales 18,50,000 minus variable cost. Just now we have calculated variable cost 14,61,500. First we subtract in denominator 18,50,000 minus 14,61,500 will get 3,88,500. Denominator. Numerator same, 3,15,000 into 18,50,000. Now if you solve, you will get 15 lakh. That's it. So first question completed. Break-even sales we have calculated, 15 lakh. Second question, it is asking you, what is the profit at budgeted sales? At this level of sales, how much is the profit? Now, sales are 18,50,000. From sales, we subtract variable cost. How much is the variable cost? 14,61,500. Deduct sales minus variable cost, will get contribution. The contribution 3,88,500. From contribution, deduct the fixed cost. The fixed cost 3,15,000. The profit is 73,500. So 73,500 is the profit at the budgeted sales of 18,50,000. That's it. Second question completed. Third question, profit is how much if sales dropped by 10%? If sales are decreased by 10%, how much would be the profit? So first we calculate new sales. Presently budgeted sales are 18,50,000. From 18,50,000 we deducted 10%. So sales, new sales, 18,50,000 minus 10%, you will get 16,65,000. The new budgeted sales is 16,65,000. From budgeted sales, deduct the variable cost. Variable cost is 79% of sales. Whatever sales are there, 79% is variable cost. So 79% of 16,65,000, 13,15,350. Subtract, we'll get the contribution, 3,49,650. From contribution, deduct the fixed cost. Fixed cost will remain same, 3,15,000. Deduct 34,650 is the profit. This profit will get if the sales are dropped by 10%. Same question it is given, if sales are increased by 5%, how much would be the profit? Profit is equal to how much if sales increased by 5%. So new sales 18,50,000 plus 5% because increased. So it will become 19,42,500. This is the new sales. So sales are 19,42,500. From this we subtract variable cost. Variable cost is 79% of sales. So 79% of 19,42,500, 15,34,575. Subtract sales minus variable cost, we get the contribution, 4,07,925. From this deduct the fixed cost. Fixed cost 3,15,000. So profit we got 92,925. That's all. This is the end of problem number 6. Now I am coming to problem number 7. The sales and profit for 2016 and 2017 are as follows. Here two periods are there. 2016 first year and 2017 second year. Whenever two period data is given, we can calculate PV ratio by the formula change in profit by change in sales. So here 2016, 2017. Sales are given. In 2016, sales are 1,50,000, profit is 20,000. In 2017, sales are 1,70,000, profit is 25,000. So 2 years sales and 2 years profits are given. Calculate, find out. PV ratio, first question. Second question, BEP. Third question, sales are how much if for a profit of 40,000. If you want 40,000 desired profit, how much would be the sales? Fourth question, profit is equal to how much for sales 2,50,000. If sales are 2,50,000, how much would be the profit? Lastly, margin of safety at a profit of rupees 50,000. So 5 different questions are asked. It's very easy. All the problems are based on the formulae. If you are perfect on the formula, it's very easy chapter. So I suggest you, whenever you listen, whenever you watch the video, always keep a pen, notebook as well as calculator beside you. When I explain something, immediately note it down. Make calculation yourself and check whether it is correct or not. Then only you can learn. Don't simply, watch the video. At the same time, you work out. Now, first of all, 2 period data is given. PV ratio. PV ratio formula, change in profit by change in sales into 100. Change in profit. Last year profit 20,000. Current year profit 25,000. So 5,000 is the change in profit. Change in sales. Last year sale 1,50,000. Current year sales 1,70,000. So 20,000 is the change in sales. So 5,000 by 20,000 into 100, 25% is PV ratio. First question completed. Now second question is asking you to calculate the break-even point, BEP. The formula is fixed cost by PV ratio. But we don't have the fixed cost. Fixed cost not given in the problem. We make use the formula of PV ratio to find out the fixed cost. After calculating fixed cost, easily we can calculate break-even point, right? So by using PV ratio, we will find out fixed cost. So PV ratio formula C by S. In place of C, we can write S minus V, or we can write F plus P. Anything we can write. But here I apply F plus P. Why? Because I need fixed cost. I want a fixed cost. That's why I'm replacing here F plus P by S. Now PV ratio, already we got PV ratio 25%. Instead of 25%, I will take 0.25. If I take 25 here, then I have to multiply by 100 here. Left side, if you take in percentage, RHS we have to multiply by 100. If you don't take percentage, then don't multiply by 100. So here 0.25 is equal to F. We don't know. We have to find out. Profit. Take the profit of the first year. First year profit is 20,000. So in place of profit, I am writing 20,000. The first year sales are 1,50,000. So whichever profit we have taken, the same year sales we should take. We have taken the profit of first year, take the sales of the second year. And also we can take the second year also, it depends on you. We'll get the same answer. So 20,000 rupees is the profit, 1,50,000 are the sales. Now cross multiplication, F plus 20,000 is equal to 0.25 into 1,50,000. So 0.25 into 1,50,000 you get 37,500. So F plus 20,000 is equal to 37,500. Take this 20,000 to RHS. So 37,500 minus 20,000, 17,500 is the fixed cost. So we got the fixed cost by using PV ratio. Now easily we can calculate the BEP. The BEP formula, fixed cost by PV ratio. Fixed cost just now you got 17,500 and PV ratio already we have calculated 25% or 0.25. 70,000. 17,500 divided by 0.25, 70,000. That's all. Break-even point we got. The two bits we have completed. The third bit, sales is equal to how much? For a profit of 40,000. If the firm wants to earn a profit of 40,000, how much would be the sales? Specific formula is there in marginal costing. Sales required to earn a desired profit. Here desired profit is 40,000. So the formula, sales required to earn a desired profit of 40,000 is equal to fixed cost plus desired profit divided by PV ratio. Fixed cost already we have calculated 17,500. Desired profit is given in the problem 40,000. PV ratio just now we have calculated 0.25. So 57,500 divided by 0.25, 2,30,000. So when we make the sales of 2,30,000, we will get a desired profit of 40,000. That's it. 3 bits completed. Now fourth bit, profit is equal to how much for sales of 2,50,000. If sales are 2,50,000, how much would be the profit? Again, we'll make use the formula PV ratio. It's a multi-purpose formula. For many purposes, we can apply this formula of PV ratio. Now, profit is equal to how much for a sales of 2,50,000. So PV ratio formula C by S. In place of C, again I am taking F plus P because I need profit. Because I need profit, that's why I am taking F plus P. Right? Now, 0.25 is equal to fixed cost 17,500. Profit we don't know, we have to find out. Sales are 2,50,000 given here. Sales are 2 lakh. Cross multiply 17,500 plus P is equal to 0.25 into 2,50,000. 62,500. So 17,500 plus P is equal to 62,500. P is equal to 62,500 minus 17,500. You will get 45,000. So when the sales are 2,50,000, we will get a profit of 45,000. That's it. 4 bits we have completed. The last bit it is asking you MOS. Margin of safety at a profit of rupees 50,000. There are 2 formulas for MOS. First formula, actual sales minus break-even sales. Second formula, profit by PV ratio. Both the formulae will give you the same answer. In our problem, profit is given 40,000 and PV ratio already we have. So simply we can substitute and get the answer. MOS at a profit of 50,000. MOS formula, profit by PV ratio. So 50,000 divided by 0.25. 2 lakh rupees is the MOS, margin of safety. That's it. Now, 8th problem. From the following data, which product would you recommend to be manufactured in a factory? Time being the key factor. Company is making 2 products, product A, product B. Now, which product do you recommend to manufacture if time is the key factor? Key factor or limiting factor means that factor which stops the activity of the business, which controls the activity of the business. So every business will be confronted with one or the other key factor. Some businesses may lack material, so material is the key factor. Some businesses may be having material, but they don't have the labor time. Labor is the key factor. Sometimes material is there, labor is there, but finance is lacking. So finance is the key factor. So in such a situation where there is a key factor, how to take the decision? Which product we should manufacture? So first of all, we should calculate the contribution per unit. If there are no limiting factors, no key factors, that product is suggested which is having more contribution per unit. If no key factor, if key factor is there, then we calculate contribution per unit of that key factor. In our problem, time is the limiting factor, key factor. So we calculate contribution per unit per hour. Contribution per hour, because unit of time is hour. Unit of time is hour. So we calculate contribution per hour. So whichever product gives more contribution per hour, that product is more profitable. So here, how to evaluate? See here, particulars, product A, product B. Selling price is given in the problem, 100 rupees selling price for A product, 110 rupees for B product. Now variable cost. Variable cost consists of direct material, direct labor and variable overheads. So in our problem, direct material are given 24 rupees, 14 rupees. Direct labor 2 rupees, 3 rupees. Variable overhead 4 rupees, 6 rupees. So total variable cost are 30 rupees for A product, 23 rupees for B product. So we got the selling price, we got the variable cost. Selling price minus variable cost, we'll get the contribution per unit. So here A is the selling price, B is the variable cost. 100 minus 30, 70 is the contribution per unit. Here 110 minus 23, 87 is the contribution. Now, if there are no limiting factor, we suggest the company to make B product, because B product is giving 87 rupees contribution per unit, whereas A product is giving only 70 rupees. The B product is better. But when B product is better, if there are no key factors, no limiting factor. But in our problem, time is the limiting factor. Now we consider standard time to produce 1 unit. It is given in the problem. Standard time per unit 2 hours and 3 hours. Now we calculate contribution per hour. The formula for contribution per hour, contribution per unit divided by standard time to produce 1 unit. What is the contribution per unit here? 70 rupees. And standard time 2 hours. So 70 divided by 2, 35. That means every hour 35 rupees contribution will get from A product. And B product, 87 rupees is the contribution per unit and 3 hours is the standard time. So 87 divided by 3, you will get 29. So in this case, 29 rupees per hour contribution will get from B product and 35 rupees is the contribution per hour we will get from A product. Now whichever product has more contribution per hour, that product is better. So obviously 35 rupees are more. So we can suggest, finally we recommend the company to manufacture product A, since the contribution per hour is more for product A. That's it. So in this video I have completed 4 more problems. So totally 8 problems I have completed in these 2 videos. So we'll continue the next problem inshallah in the next video.